Welcome everybody to this live session about the MOOC organized by HEC and AXA IM. It's now time to answer the questions you could have about this MOOC. To begin, I'm going to introduce you to the various people in the room with me. First, on the HEC side, you will hear Hugues. Hugues Langlois is in charge of the content on the HEC side. Also with us, Vanessa, project director of the MOOC, and Francis as well. On AXA IM side, Marion Lemoredec, she worked on the content and is a fund manager. Shenjun is the MOOC coordinator on the AXA IM side, and myself. As you might have noticed, some of us are not native English speakers, so please be kind with us during that live session. Just before the questions, either from the forum or live questions, a few topics, a few numbers about the course, content, feedback, and difficulties some of you might have experienced. First, as of today, a bit more than 4,700 learners are registered into the MOOC, coming from 82 countries, from all over the planet, as you can see on the small map you have on the right. Positive feedback globally about the MOOC, 97% likes, plus a global grade of 4.5 out of 5. Switching to the feedbacks, thanks a lot. Many positive things. It's quite nice to see on our end that what we have tried to design for you seems to be relevant and positive. I won't comment all the positive things. Structured, clear, useful, rigorous, advanced. Apart from those positive feedback, also some reaction about the difficulty of the MOOC in itself. Too much mathematics for some, too many formulas without clear example provided. All those feedbacks, of course, are carefully looked after by the team. We are trying to do our best to improve on a day-to-day basis based on your feedbacks and remarks, the content. Some of you might have noticed some bugs, not that many, but still bugs. All of them should have been sorted out by now. There has been also some question around having more examples, concrete examples, in the course, just to facilitate the use of mathematical formula, and we have progressively added some content, and we will continue to do it, of course, based on your feedbacks. Let's now move to the question, the one coming from the forum. You can see on the screen the first one. What is a typical day or week of a portfolio manager? Maybe Marion, that one is for you?
Yes, I think this one is for me, as I am a portfolio manager, so I think I can definitely answer that question. Typically, a portfolio manager's day starts with trying to catch up with what happened overnight, trying to catch up with the news flow to see if there was a central bank's meeting or corporate event or any major market movements. So usually we can have some morning meetings, or we will read comments as well. So catch up with the news flow is definitely the first thing we are doing. Then the second important thing is that we are checking our positions, our systems, checking, for instance, the level of cash, the active strategies of our portfolio in a nutshell, to see if everything looks fine, if there was no problems of settlement, if the portfolios seem to be aligned. So that's a really sanitary check that we are running on the system. And then we are looking at the market activity when the market opens. For instance, if you're a fixed income portfolio manager like me, you would look at who is issuing debt in the market today, be it corporates or governments. If you're an equity portfolio manager, you can look at how the IPOs are going on. And then most of the time we are meeting with strategists, economists, treasuries as well. This is really part of our day to analyze what's going on in the market together with some other market participants. Then the portfolio manager is really at the center of the organization in an AXA, in an asset management company. So we are spending a lot of time with some other teams within the company. So it can be discussing the reporting, talking with the marketing team, talking to the middle office, back office, etc. And then the more you have seniority in the job, the more you're spending time with your clients. So you are taking some time to write some reportings, to pitch some new funds, some new mandates, to develop some new funds together with some other internal teams and your clients. And then you are reporting as well with your clients on the activities of your mandates, the activities of your funds, what you've been taking in terms of active strategies, why, how it worked, did it work well, did it not work. So the more senior you get, the more time you are spending with your clients as well. That's about it, I think.
Marion, thanks a lot. Another question, this one more about the career path. What do you think is the proper career path in investment field for people graduating from business schools with finance and business backgrounds? Hugues?
Yeah, hello. So thank you for your question. I don't think there's one exact answer to this question. It really depends on, first of all, the type of portfolio manager that you want to become. By type of portfolio manager, what I mean is what kind of portfolio, what kind of assets that you want to manage. So to give you an example, if you want to become a discretionary equity fund manager, then that requires a different set of skills, a different analysis than if you want to become a derivative trader, for example, or a fixed income fund manager. So in your case, if you have an undergraduate degree from a business school, so in finance, economics, or more general business studies, I think one good option would be to obtain your CFA designation, so your CFA title. If you want to shoot for a career in a more quantitative position, so for example, if you want to become a fixed income portfolio manager, then it might be a good idea to go on to continue your studies and to complete a master's in a slightly more quantitative field. So for example, a master's in financial economics, or a master's in mathematical finance or financial engineering. Whereas if you come from a science or engineering background, well, in this case, you already have the quantitative tools. So in this case, simply completing a master's in finance and or your CFA designation might be sufficient. So it really depends on your background. So in this case, you have a background in a business school, and also the type of portfolio manager that you want to become.
Thank you, Hugues. We have another question related to the probability to experience lower returns compared to the historical returns. The question in itself is, do you believe in these lower forecasts that investors in the future most likely will have to accept compared to their historical returns? Marion, maybe for you?
Yes, I would tend to agree with that, with the fact that, yes, investors should expect probably lower returns in the next futures. Well, first, maybe we can have a look at how we can assess the situation first on the fixed income side and then on the equity side. But clearly, in fixed income, the expected returns are linked to the levels of growth and inflation. That is to say, by deduction, the level of nominal yields that you have in the market. And currently, it looks like we are heading towards lower growth, lower inflation that we've had in the past. So that argues really in favor of lower returns for fixed income overall. Then equity, I mean, the expected returns within equity relates to the outlook for corporate profits. And it's true that the outlook for corporate profits overall is probably not as attractive as it was over the past decades, if we talk about that time period. So I would tend to agree with that, but I think it makes sense to look also for other opportunities for other markets where probably disruptive technologies will enable to have higher expected returns than some traditional asset classes. And I think anyway it makes sense that if you want to have higher expected return, as we've seen, you are taking more risk as well.
Thank you, Marion. Another question, maybe for Hugues, are there some online tools to measure our risk aversion ourselves?
That's a very good question. So you can, if you Google risk aversion measurement, for example, or tool or questionnaire, then you'll find a few websites that do offer questionnaires that help you figure out your risk aversion. I would tend to be careful though. So risk aversion may change. The exact definition of risk aversion may change depending on your preference. So in this MOOC, we're looking at one simple example of preference, meaning the trade-off between expected return and a portfolio variance. If you change your preference, then the exact parameter of your preference function, your preference metric, may change. So I would tend to be careful about determining an exact value for your risk aversion parameter. So in this case, if you take this, this preference metric that we've been using in our MOOC, so the trade-off between portfolio expected return and portfolio variance, then in this case, I can tell you that a typical value ranges from, let's say, 1 to 10. So what you can do is compute your portfolio allocation for different levels. So for example, with 1, with a risk aversion of 2, 3, 4, 5, up to 10, and then look at the resulting portfolio volatility and portfolio allocation, and then determine if, with which portfolio allocation you are more comfortable. Clearly, if you use for example, a risk aversion of 2, and the optimal portfolio allocation is, let's say, 150% in the stock market, then clearly it may not, make much sense for you in this case. So in this case, you may want to increase your risk aversion parameter until you are comfortable with your portfolio allocation. So you can find online tools to help you figure out your risk aversion level. Keep in mind that if you change your preference metric, then the exact definition of risk aversion may change as well. And keep in mind, most importantly, that the exact value of your risk aversion is not the important thing here. It's not the key issue. What you need to figure out is whether you are more aggressive or more conservative. So for example, a typical portfolio allocation could be 60% equity, so stock market, and 40% government, safer government bonds. If you are more aggressive, then you may tolerate in your portfolio an allocation of, let's say, 80% equity and 20% bonds. And if you are more conservative, then you'll be better off, for example, with a 50-50 or a 40-60 allocation.
Hugues, thanks a lot. Another question: where can I learn more to evaluate an investment and read charts so I know when to enter and exit a market? Hugues, probably.
Well, that's the eternal question in finance. So what I would suggest, if you're new to the world of investment, is to have a look at a book called Investments by Bodie, Kane, and Marcus. Yeah, so Mark Bodie is by Bodie, Marcus Bodie and Marcus. Yeah, so you have different editions. Just use the latest edition. So this is really a Bible in investment management. And in this book, you'll find a discussion of different approaches, including what I think you're referring to, which is a bit more about technical analysis. But you'll also learn or read about different economic variables, different economic indicators that are good to use. But I would suggest to start with this book to have a deeper discussion of the different tools to trying to time your entry and exit of a market.
Hugues, thanks a lot. Another one, also a bit technical, which are the best platforms to start investing, especially in a demo version?
That's another very good question. So, of course, you'll understand that I cannot promote any of the online platforms. What I can tell you, though, is that you have online banks, you have online discount brokers, but also financial websites, in many cases maintained by financial journals or newspapers that let you try out or backtest different strategies, so different investment strategies. They differ in terms of the tools and what you can do on them. So in some cases, you'll be able to just trade in a demo account. So for using in more advanced version, you'll be able to code or program sophisticated investment strategies and try them out on historical data.
Thanks a lot. Maybe it's time now to switch to live questions. Probably one small thing before we begin. We already received some questions, but we won't be, of course, in a position to give any investment advice. That's not the point of that course, nor discuss any strategy coming from AXA or AXA IM. Don't be surprised if the question sticks to the content of the course. Maybe the first question is, let me go back to it. Where do you think structured products, and it has switched, sorry, give me 1 sec to find it back. Yeah, where do you think structured products are headed as a product and as a professional career? Marion, that one is for you, probably?
Yes, that one is for me, as I have experience both in structured products and managing plain vanilla funds and mandates, actually. So I have a personal opinion on that. What has been clear is that since the global financial crisis in 2008, the share of structured products within all the instruments and financial assets traded has clearly decreased. And that was really one of the very direct consequences of the global financial crisis. And over the past few years, I would say over the past 2 to 3 years, some structured products seem to be coming back. And I see more and more of these traded on the markets and some suggested trades as well. My personal view is that they will remain on the side because we are really in a low yield environment and low expected returns environment. So I think it's going to be difficult to see a revival of structured products. I think the global financial crisis, one of the consequences was tougher regulation on this kind of products for banks, for asset managers as well. In a low yield environment, there is also less room for this type of sophistication. I think one of the consequences as well is that we need to have a better understanding of these structures, and you don't want to have a final investors buying into a structured product without knowing, understanding the type of risks that they are taking. So this is really also for this reason that I think structured products will probably not go back to the levels of trading, of activity, of suggested trades that we've seen in the past.
Thank you, Marion. Looking back to the question we have, maybe a technical one, either for Marion or Hugues. Someone is asking whether you could explain a little bit the difference between maturity date and redemption date for bonds. In your view?
It's the same thing. The maturity and the redemption of a bond is really the exact same thing. It's purely two different words, but that's really when the bond is going to expire, is the maturity of the bond.
There's a follow-up question from the same person about the duration for bonds. So I can begin, and maybe you could complete my answer if you want, Marion. So the duration is the weighted average of the time to maturity to different cash flows of a bond. So for example, if you have two bonds that mature in 10 years, right? So you'll have your capital back in 10 years. If they offer one coupon, for example, so in one case, in the first bond, the coupon is paid, let's say, after 1 year. And then in the second bond, the coupon is paid after 9 years. Then the exact timing of the different cash flows of the two bonds, with a maturity of 10 years in both cases, is not the same. So the duration will take that into account, and will give a lower duration for the bond with the cash flow that's coming after 1 year.
Thank you, Hugues. Another question on the ETF. Marion, probably.
So the question is,
do you think that smart beta ETF are undermining active management? Could they be used along with active investment management decisions?
Well, I wouldn't say that they're undermining active management, but clearly you can see on both sides, on one side you have the active management, on the other side you have passive management, with pros and cons for both types of strategies. In the middle, you also have some strategies that have started to emerge a few years ago, which are smart beta type strategies. I think we can combine all these strategies in some portfolios. I mean, for some types of instruments, it makes a lot of sense to go for active strategies. When, for instance, you have some
Yeah, we might have lost
biases of liquidity managed in active management. Then some assets are very well fitted for ETF, for instance. So I think I wouldn't say that ETF are going to undermine the active management. I think there is clearly room for any types of management, and the investors need to be well aware of the types of risk they are taking, either with the passive risk, because there are some risks together with the ETF, and also with the active management. But I think it argues for, on the active side, probably more active management, and on the ETF side, more transparency.
Mario, thank you. Hugues, there is another one for you.
Yes, so I'd like to answer a few questions that I've seen. So I'll repeat. I've been asked to repeat the name of the investment Bible that I talked about previously. So the book is called Investments by Alex Kane, Mark Zweibody, and Alan Marcus. So one of the reasons why I suggest this book is that it also covers a lot of topics that are being covered in the CFA designation. So it's a nice book with which to start, your exploration of different approaches in investment management. I also have a question about the math knowledge, or the mathematical background that you need to complete the course. So in this case, I would say that you need enough, basic mathematics to be able to compute something like average return, variance, for example. And we also have one allocation formula in the course. So basic mathematical skills. So this is not, so you will not find only definitions, for example, in this MOOC. So there is some, mathematics involved.
Alors, I see that we have some other question, not sure to understand that one. The difference between unfunded swap model and funded swap model of synthetic ETF. There, I don't know who should be getting that one, or if there is an answer to that one.
So I don't think it's the place to get into that much details about different financial instruments. So I'll just say quickly that in the ETF swap, so the ETF provider enters a swap with a counterparty in order to get the return on the underlying assets, the underlying portfolio, and the funded versus unfunded is a technical issue. Is a technical issue. So let's not get into that level of details.
Thank you. I'm looking at the question. Again, probably for you, Hugues, and I'm not entirely sure it's right in the content of the course, that question around metrics to take decisions, or some, either one or the other.
Yeah, sure. So, so if I look at the question, so what would be your advice for a beginner? Well, my advice for a beginner wouldn't to be, to focus on specific metrics, to make investment decisions. So I would be looking mostly about building a balanced portfolio of low-cost financial products. So that would be for a beginner. If you're a little bit more advanced, then you're looking for financial metrics that will predict either the investment reward, so what we called in the course the expected return of different investments, and the amount of risk. So one good metric, for example, that works really well in different asset classes would be the yield, the cash yield, so dividend yield, for example, for stocks or equity indices. That would be one economic indicator that I would be looking at. So, for example, you could compare the level of the dividend yield or the PE ratio, for example, of one particular market compared to its historical average, and then figure out whether it's a good time to buy or not. But that's really at a more advanced level, so I wouldn't suggest trying to have a look at this, these types of economic indicators if you're a beginner in the investment world.
Marion, a question for you potentially. Do you use technical versus fundamental analysis in your day-to-day portfolio management?
I mean, we tend to use both, but definitely we use much more fundamental analysis in active portfolio management. I think technical analysis is probably now much more used for traders rather than portfolio managers. Technical analysis is going to refer to probably much shorter term active strategies that the types of strategies we would implement in asset management. So definitely we are in active management using much more fundamental analysis.
Now, do we have other questions? Another one. How to say which one should pick that one and whether it's. What is your perception? Oops. Sorry, it moves. It moves too quickly on my screen. Okay, a question on emerging markets. Marion, maybe for you?
Yes, the question is, what is your perception on investing in company from emerging markets?
Yes.
Well, my perception is that it's really a job in itself. And analyzes stocks from emerging markets is something which is very different from analyzing stocks in developed markets, which is why most of the time in asset managers you would have dedicated teams of analysts and portfolio managers. So there is clearly much more volatility to expect, much more bankruptcies to accept as well, and you have to pay attention to some specific risks that probably are less relevant in developed markets. So that's probably not the area to start with, emerging markets, because there's more volatility, more sophistication in the analysis that you need to have. But I mean, that's clearly a very interesting markets, and there are opportunities in those markets, but they require specific analysis.
Thanks a lot. There is also a good question about the difference between asset management companies and hedge funds. Do they have the same investment philosophy and the same investment universe? I would be tempted to ask to Marion, because she's on the asset management side, but I'm sure, Hugues, you could also, which one of you?
I can begin if you don't mind, Marion.
Sure.
So I would say that the biggest difference is mostly in terms of regulations and financial constraints. So in many cases, hedge funds are going to be less constrained than a traditional asset manager, but also on the regulation side. So they can invest in more things and more freely. They cannot advertise the same way, for example, to potential clients. So that's one difference in particular. But in terms of investment philosophy, I don't think that there is a big gap between the two. So you see often people going from a traditional mutual fund to a hedge fund and vice versa. But you also see more developed asset management firms managing both types of investment vehicles, so both mutual funds, for example, and hedge funds.
We have another question, typically linked to the environment we have, the environment in which we have negative rates or very low rate level. Marion, do you want to take that one?
Yes. The question that I see is, do asset management firms turn into high-yield bonds or equities? And how does this negative yield environment affect the ability of asset management firms and pension funds to meet their long-term liabilities? I mean, that's clearly a very good question and a major concern for investors at the moment. I wouldn't say that it pushes asset managers more into high-yield bonds or equities. I think it can push the final investors into those riskier asset classes, yes. But asset managers, anyway, are sticking, to their dedicated funds, and then it's up to the allocators probably to, if they want to add more risk, yes, they will probably add more exposure into high yield or into equities. But asset managers are just there to meet those clients' requests. And so far, I think the regulations have prevented those long-term investors to switch massively into more riskier asset classes, which is a positive thing. But at the end of the day, yes, definitely, pension funds will probably have difficulties to meet their long-term liabilities in these very low yield or even negative yield environments. So we have to find new solutions.
Thanks a lot, Marion. Hugues, another question for you.
Yeah, so we received a few minutes ago a very good question about stochastic calculus. So whether stochastic calculus can tell us something about investment management and how to master the idea of a Brownian motion. So the important thing to understand in this case is that stochastic calculus or continuous time finance or tools in continuous time is really a tool to answer or solve some problems that you may have, for example, in derivative pricing, but also in portfolio management. In many cases, and including the ones that we deal with in this MOOC, it's not necessary to rely on such a complicated mathematical tool. You don't need it. You would need it, for example, if you were solving a intertemporal portfolio management problem. So really a big problem in which you want to allocate your portfolio for many, many years with intermediate rebalancing along the way. But this is not the level that you have in this course. Also, I would simply point out that when you say how to master the idea of a Brownian motion, so a Brownian motion is a continuous time process, which is very useful to solve, again, different problems. It is not perfect, so it doesn't capture, for example, jumps that you see in financial markets, but you have exactly the same idea or the same issue in discrete time finance. So for example, in this course, when we say that we measure risk by using variance or the square root of variance or volatility, well, we assume that we capture everything about risk with this measure, which is not entirely perfect, for example. So as you've seen, or you are going to see in Module 3 with Maxime Halimi, there are a lot of downside risk in financial markets. So the likelihood of losing a lot of money on any given day. So this amount of downside risk is not necessarily well captured by the volatility or variance measure, just as in continuous time finance, a geometric Brownian motion doesn't capture some types of risk.
Hugues, thank you. Marion, we have a question regarding, sorry, I'm trying to find it back. Regarding portfolio management and investment for beginners and amateurs.
Yes, the question is where to start, basically. Yep. Either to study thoroughly companies and follow up closely the economic and financial views. And then the related question is a virtual portfolio on a trading platform a good start? Definitely, yes. I think what's important to start with is to have a virtual portfolio, because that's really how you are going to see exactly how it happens in real life. So I would definitely recommend this. And I think to start from the very beginning, to follow the economic and financial news, yes, it is key. And I would recommend not to go first into the corporate specifics, because then you are going to be overloaded with a lot of details coming from all over the world, all the companies, everywhere. So you will not know where to look at. So focus at one asset class. I mean, if you're passionate for telecom stocks, well, focus at telecom companies for the time being. look at one index, for instance, and try to, in your virtual portfolio, select the stocks within that sector that is going to, you expect, outperform the index. So you can take an example like this. Focus at either a sector or a country that you like, and then try to see how it goes between selecting purely the index and then making some active decisions within that index in a virtual portfolio. That would be my advice to start.
Hugues, a question for you about modelization and
yeah, I have it. So we have a good question. So to allocate a portfolio of stocks, do you use Harry Markowitz's theory? So basically the mean variance portfolio selection theory that we have, that we discussed in Module 2, for example, as a portfolio manager. Are there other alternatives to allocate portfolio of assets? So we have a portfolio manager in the question, so I'll let you answer perhaps the question after Marion. But I would say that the basic Markowitz optimal portfolio, as we discussed in Module 2, for example, is very dangerous to apply in real life in a naive manner. So what I mean by this is that it works if you have very good econometric tools. So a very good model to predict expected returns, but also risk, so volatilities and correlations between different assets. But even then, you need a significant amount of quantitative tools to make it work. So a simple solution that you see in the industry, for example, is to simplify the Markowitz approach. So for example, people are using the minimum variance portfolio, for example. There's also the risk parity solution, or even a simple solution that like an equally weighted portfolio. So simply putting the same amount in each of the assets. In terms of alternatives, well, it actually depends on your preference metric. So if you care about the trade-off between your portfolio expected return and your portfolio variance, then the type of portfolio that we discussed, that we covered in Module 2, is the right answer. But of course, if you have a different preference metric, then the portfolio solution will be different. So for example, if you also care about downside risk, so for example, minimizing the probability of losing, let's say, more than 10%, then the optimal portfolio allocation in this case will be different than the mean variance optimal portfolio that we covered in Module 2. So for these types of portfolio, you would have to go to continue, studying investment management, to go to more sophisticated methodologies.
Marion, do you want to add something, or do you prefer to switch to the next?
I mean, Yuko's answer was pretty complete and very close to the reality. So no, I think it's fine.
Just to wrap up, so the optimal mean variance portfolio works if you have very good econometric methodologies, but applied in a naive way. It's not a really good place to start. So I would look for a simpler portfolio than trying to combine optimally different assets.
Thank you, Hugues. Following the question you answered, Marion, about low rate environments, someone is asking, and again I need to scroll back, is asking to whether you could clarify the search for yield topic, and second, things are getting too quick, and there, to what extent regulators are limiting this riskier search for yield in the current environment?
Yes, when I'm thinking about these changes in regulation, I'm thinking about the regulation for banks and insurers, for instance. These are the most obvious ones. Banks and insurers have to put in front of their investments some capital, and there has been more and more capital requirements. So it means that banks and insurers have to be holding liquid assets, which means less risky assets as well. So that's a typical example of how the regulators are implicitly limiting the riskier search for yields in this environment.
Merci. Thanks a lot, Marion. Another question. Someone is asking whether which of the two options are the best, a Kaya or a CFA, for a young starter who wants to join the asset management industry today. Hugues?
Yeah, so just to introduce, so Kaya is about alternative investments. I wouldn't suggest one over the other. The CFA is a bit longer to complete, so you have 3 different levels, whereas the Kaya can be done more quickly. You may not like my answer, but I would suggest to do both.
Thanks a lot, Hugues. Mario, another one, and probably more specific to a portfolio manager. How frequently do portfolio managers trade in general? Are they tempted by volatile markets to trade more, or do they use stop-loss orders? Thanks a lot.
Yeah, that's a good question. I think there is no precise and clear answer to that, because I mean, I'm a portfolio manager, and it happens I have some days where I do not trade at all, and some other days I would be trading a lot in my funds and mandates. So there is no definite answer to this question, and it really depends a lot on the market conditions you are facing. So of course, some of us are using stop-loss orders for the most standard instruments. I'm thinking about futures here. So definitely stop-loss orders can be placed into the market on futures very easily, and this is something we do extensively. Of course, it's not something that you can do that easily on some bonds, corporate bonds. So it's not the same type of orders you can place in the market. And I wouldn't say that we are tempted by more volatile markets to trade more. I think it relates much more to the liquidity conditions, because if you have a lot of volatility, liquidity conditions can deteriorate. So it's not always a positive thing to have more volatility, but the positive out of that from a portfolio management point of view is that you can have more opportunities to lock in some entry levels that you're interested in. So these volatile environments will give you opportunities to lock these interesting levels. So you would not trade more, but you will have probably to be more active in these volatile markets, to be more more cautious on the levels you are entering into. That's what I wanted to say.
Thanks a lot, Marion. Hugues, a question for you. In what context would one prefer equal weighted indexing? What are the benefits and the drawback?
Okay, so in what context? I would say in the context where you cannot predict much about either investment reward or investment risk. And what I mean by this is the following. So the optimal mean variance portfolio that we saw in Module 2 is actually equivalent to the equal weight portfolio if you assume that all expected returns across assets are equal, all volatilities across assets are equal, and all cross correlations are equal across assets. So basically, you don't know much about the different assets you're looking at, so you cannot differentiate between their either expected return or amount of risk between these different assets. So in this case, you fall back on the equally weighted portfolio. So again, the equally weighted portfolio, you place the same amount in each of the different assets. So in which circumstances this makes sense? Well, for example, if you have a portfolio of large companies, so if you were to do an equal weight portfolio of, let's say, the stocks in the S&P 500 or the CAC 40, for example, in France, or the FTSE 100, in this case, these are large companies, large and liquid companies. So, the equally weighted portfolio may make sense in this case if you prefer it to the traditional cap-weighted index. However, think of using the Russell 1000 as your investment universe instead of the S&P 500, for example. So the Russell 1000 is approximately the 1,000 largest companies in the traded in the US. So in this case, you have a lot of those companies which are relatively small and less liquid stocks. So in this case, allocating as much money to a small company as you would allocate to, let's say, Apple or Google, so now Alphabet, doesn't make much sense. So it really depends on your investment universe. The same, for example, for commodities. Well, in this case, putting exactly the same amount of money in each of the different commodity, regardless of their category, doesn't make much sense. So one of the drawbacks of the equally weighted approach is that, for some investment universes, it makes sense. For other investment universes, it doesn't make sense. So this is one, the biggest drawback actually. But again, the biggest advantage is that you don't need to predict anything about these different assets. You don't need to predict the expected returns, nor the amount of risk, so volatilities and correlations.
Thanks a lot, Hugues. I think that the time has come to end our live session. You were quite a lot, in fact, a little bit more than 90 people. Thanks a lot for your participation, all your questions. We were very happy to be there. It's good to face the students of that MOOC after having worked on it. So it was a pleasure for us as well. Keep in mind that there are forums and chats on the Coursera platform about the course. We will continue to answer questions or add any stuff, any material that would be necessary. There are challenging ones, some which are more concrete and easier to deal with. So have a great course, and probably there could be another live session at some point. So stay tuned. Hugues, Marion, any additional word?
Sure. Well, again, as you've said, thanks to all of you for all of your good questions. Please continue to post questions on the forums. We'll be happy to participate in the different discussions online.
Thanks a lot to everybody, and see you or speak to you soon for a later session. Bye.
Bye.